Is oil about to cause a massive global recession? Scary YouTuber intro. I mean, probably. When? Let's figure that out together. My name's Nick. I've been a professional investor and unprofessional trader for 24 years. Before I start, I'm not a financial advisor. This is not an inducement to buy or sell any assets. And most importantly, do not try and predict the start of a recession. It never works out. But we're going to do it anyway because it's fun. So let's figure this out together. Look, right now, crude oil is at $110 a barrel. And most people think that this situation is going to resolve itself. But the problem is that futures prices only reflect Wall Street's optimistic, or people's rather, optimistic perception of future geopolitical resolutions. But the physical spot price of oil is now trading at $140 versus $110. So this extreme $30 divergence between the paper contracts that traders gamble on and the physical barrels that airlines, manufacturers, shippers are forced to actually buy today. I mean, this is the most extreme. No, it's not the most, but it's one of the most extreme dislocations that we've seen. And this is all because of the Strait of Hormuz. Look, I'm not going to go on about it. Everyone knows what's going on in the Strait at this point. Jet fuel prices, by the way, they've surged 80 to 100% since this conflict began, forcing United Airlines to model their operations around $175 per barrel oil through to 2027 and costing American Airlines $400 million in the first quarter alone. Aviation ticket prices are up as much as 124% on some routes. This isn't even a speculative premium. It's a physical emergency. But is this just an isolated problem for the transportation sector? No. Look at what happened in July of 2008 when physical oil hit its all-time record high of $147 a barrel. That massive energy shock shattered consumer discretionary spending, paralyzed the credit markets, and acted as the final catalyst that pushed a fragile housing market into a global financial collapse. The underlying mechanism today is exactly the same, and that's the problem. Let me explain exactly how this identical mechanism is going to impact our purchasing power over the next few months. Oil is the foundational input for literally everything. And the UN's Food and Agriculture Organization just issued a 40-day warning that this crisis is bleeding directly into the global agriculture sector. Roughly 30% of the world's fertilizer trade passes through the block strait, and nitrogen urea prices have already exploded by up to 60%. So up to 60%, but a lot of estimates are like 10 to 30% on average, right? So because farmers cannot simply skip applying fertilizer without destroying crop yields for the next 2 years, the FAO is now projecting that global food prices will surge 15 to 20% in the first half of 2026. This cascade is already happening with wheat up 4.3% from droughts and planting declines, and sugar up 7.2% as Brazil diverts its sugarcane to ethanol production just to offset its energy costs, which is crazy. Like, all these knock-on effects are crazy. So this guarantees a textbook stagflationary shock where the cost of basic survival skyrockets while economic output grinds to a halt. The US economy already delivered a shocking 0.7% GDP in the fourth quarter of 2025. And Goldman Sachs is now warning that second half of 2026 could enter a stall speed at just 1.25%, right? Which is not good, but a lot of people are thinking it's going to be lower than that. Anyway, every sustained $10 increase in oil shaves another 0.1% of US GDP growth, and Goldman knows that this negative impact doubles during geopolitical crises. So the math of the whole economy is breaking, while the Federal Reserve adopts a wait-and-see approach and retail investors hope for rate cuts that are never coming probably. The smart money is aggressively positioning for what they feel is inevitable. The cynical observer would say that major institutions are using public ignorance of these tiered recession thresholds to quietly exit their most vulnerable positions. Moody's Analytics warns that $125 oil is the US tipping point. Oxford Economics says that 2 months at 140 guarantees a mild global recession. And there's a lot of other predictions in the same vein. The physical market has already breached that $140 threshold anyway. So while retail traders were buying the dip on mega cap tech stocks, Wall Street is systematically dumping overvalued paper assets. It does feel like Wall Street thinks a recession is near. The big banks are hoarding physical assets like gold and silver. They're creating ways for institutional clients to short tech stocks like the Mag 7, like AI, while telling you to buy them. They're also creating ways for institutional clients and themselves to short the private credit market, while Larry Fink tries to put your 401k money into the private credit market. They basically remove their money, place your money in, and they do the old switcheroo, and then you get wrecked. It feels like the music is stopping, but just a warning, timing a recession is notoriously difficult. I joked about it at the start, but it is true. Economies can just keep chugging along longer than anyone expects with like all this patchwork fixes. And we're not going to time the recession. So what do you do in a situation like this? Talk to your financial advisor about a defensive portfolio, a portfolio that's more resilient if a recession does come. This ensures that you don't cut yourself off completely if the market somehow magically turns around. But if it doesn't, at least it's not all over for you. It's a very simple strategy that served investors well through the decades, centuries, really. It's served humanity well. Prepare for the worst, hope for the best. I'll see you in the next one.